energy ETFs are rebounding hard, and safe haven investments, why aren't they behaving so safely since the Iran war started? Well, we'll take a look at that on today's program. Let's get to it. We start with the broad picture view of the major indexes and the ETFs tracking them. We've got SPY, which tracks S&P 500, up almost 9% since the start of the year. And some of these other major asset classes performing even better than U.S. stocks. Global real estate now up by 17% and change. That doesn't even include the dividend. Seeing a nice run here in global real estate. And then, of course, commodities, which you notice here they've had a turn up again as we see the Middle East situation reigniting, and certainly those energy commodities like crude oil and gasoline and anything that's energy related is shot higher. And as a group, commodities are ahead by 32%. Now, there has been one particular outlier, which we're going to talk about on today's program, gold, which is been referred to as a safe haven. And I want to just focus a little bit more on safe havens because I think there's some massive mistakes being made by many investors and even financial professionals. And I want you to avoid those mistakes. So we're going to get into that in a second. U.S. bonds, total bond market, BND, just pretty much flat. Now, in terms of industry groups, we've got 11 industry groups in the S&P 500. 9 are up, 2 are down. So the overall picture, if we just look at S&P 500 from a sector perspective, is quite bullish when you've got 9 up and just 2 down. The 2 down I would categorize those as mild losses. We're getting close to double-digit losses, though, for some of those industry groups, XLC and XLY. So keep an eye on those 2 sectors, but the rest are positive and up. Now, in terms of other areas that have really rebounded hard and gotten kind of a second wind, energy stocks and energy ETFs, I've got a couple of leveraged ETFs that have been rebounding hard, charted here. You notice Gush, ERX, TEXU, and then XMOX, which is a single stock ETF linked to ExxonMobil. You see all of these have the very high correlation, and they're all trending in the same direction, and that's up. And if we take a broader picture view of the overall performance since the start of the year, you can see that despite all of these peaks and valleys, and we've had many, that the overall momentum still seems to the upside for anything related. And going back to that previous slide, you see that the top performer's energy, XLE. So again, if you're going to use momentum trading and if you're going to use leveraged ETFs, you always want to do it in sharply trending markets. That's probably when you're going to get the best result. And you want to make sure that you're trading in the same direction as the market, whatever that trend is. If you're bullish and that particular area is trending hard and it's got momentum, then that's when you want to be using leverage, and vice versa. If it's bearish, right, it doesn't always have to be bullish. It could be a bearish ETF or an area of the market that is trending down. Same rule applies. So just keep that in mind. And also, too, leverage ETFs in terms of context. Where does that go inside of overall investment portfolio? The way that I teach it and the way that I think makes the best sense and it's easy to grasp and also to control is in your non-core investment portfolio. So those 3 parts, core, non-core, and then your safety bucket. So non-core is where the leveraged types of ETFs go. Now, this is also where this chart here shows the safe havens, right? And this is also where a lot of investors get it wrong. They put these types of ETFs or these types of assets in their safety bucket when, in fact, they only belong in your non-core bucket, or you can use them as core. But the point is that these types of ETFs and these types of assets have confounded investors in 2026. Ron, why aren't my safe havens protecting me? Well, since the Iran war started in late February, gold long-term U.S. Treasuries and Bitcoin have all sunk in price, and they have not been a place that's protected capital. Now, again, this is not a knock on any of these assets. It's not an investment opinion on any of these assets, good or bad. My point is that safe havens sometimes aren't safe, right? And for that reason, they can and do at times, as we're seeing right now, lose value. And so the definition in my world of an asset that's truly safe and that meets minimum safety standards for your safety bucket is one that does not lose any principal, right? It protects your principal. So in that context, gold, long-term U.S. Treasuries, and Bitcoin fail. So again, this is just a reminder not to make the mistake of putting these types of assets in your safety bucket. And if you missed it, I did a webinar, a free webinar about de-risking your investment portfolio before the next downturn. I've got a link that expires on Monday, July 27th. That link will go away. You can watch the webinar. It's only about a half an hour, and digest it at your own speed. But again, July 27th is when it goes away. So hit that link in the description section below. This was one of the charts that I shared with our audience. We talked a lot about risk and safety, and especially those of you nearing retirement or already retired. There's something called the age-driven risk. And what happens is, everyone talks about time. Yeah, time is your best friend. Well, time is your best friend if you're young. Time as we get older becomes a foe. And that's because our life expectancy is less. Time is compressing as we get older. Yeah, people are living longer. I know that. But their time horizon is still much more compressed. If you're 60, if you're 70, if you're 80, if you're 50, it's much more compressed than somebody that's 20 or 30. So from an investment perspective, your risk tolerance, your ability to navigate risk is completely different because you don't have 20, 30, 40 years to recover from major losses. Plus, you're also extracting money from your investments to live off of for your lifestyle. And so the cost of one big market downturn, especially if you're managing, the bigger your portfolio, the more at risk. If you've got a 6, 7, 8-figure portfolio, one poorly timed downturn or unprotected risk is not just a setback. It can erase hundreds of thousands of dollars in just a matter of weeks and months. And that's far more expensive than simply taking preventative measures, right? And so what are the preventative measures? Well, this is what I want to introduce to all of you, Ron DeLegge's Portfolio Safety Challenge. So the question is, how much of your portfolio would disappear during the next market shock or next market downturn? What's the number? What's the figure? And then how long would it take you to recover from that, if you recover at all? And then what are the safety gaps that you're missing right now before the next downturn hits? We're going to get to the bottom of that with the Portfolio Safety Challenge. It starts on August 4th. All of you are invited. The link to enroll is in the description section below. It's going to be 3 weeks, and there's certain things here that you're going to get that you can't get anywhere else. The first thing is a before and after risk grade of your portfolio. And the idea is to identify your portfolio's weak spots so we can fix them. And then we do that right when the Portfolio Safety Challenge starts. We want to see a before and after risk grade. How much improvement did you make over the 3 weeks in terms of improving the resilience and the strength of your investment portfolio and getting rid of those weaknesses? We're also going to give you a safety cushion score, which is different than the risk score. Safety cushion score is an indicator that indicates how much of your portfolio should be earmarked for safety. So on a percentage and dollar term, that's what you will get. So these are diagnostic tools that are only available to folks that enroll in this particular safety challenge. I'm not making the tools available publicly. I'm not selling them. I could sell these tools publicly on a subscription basis, and maybe in the future at some point I will. But right now, these tools are only available. The risk rating tool and the safety cushion tool are only available to individuals that enroll in the Portfolio Safety Challenge. So you're going to get a firsthand view of what's going on with your portfolio, and also these are tools that are not available anywhere else, and I built them. They're proprietary with a team. I've been hard at work behind the scenes, and so this is something that you can benefit from. And then we're going to have a guest speaker. One thing I will want to highlight and mention that there's going to be this. The whole purpose of this cohort is getting it done, getting your portfolio as safe as possible in the shortest amount of time. So there's not going to be fluff. It's going to be homework assignments. It's going to be me, shepherding you and helping you to find what you need to be doing right now. And there's also going to be accountability. There's going to be a community of investors that all have the same goal of having a safer investment portfolio. So again, I think you can benefit tremendously by enrolling. And then this is kind of a snapshot look at what that grade looks like. There's 5 possibilities: A, B, C, D, or F. And so if you're at all concerned about market downturn, what type of impact that would have on your family, on your lifestyle, on your portfolio, and what you should be doing right now to prepare yourself, you need to be there. You need to be there. And we're going to help you also avoid the top 5 portfolio safety traps. And we already kind of covered one of them in today's episode. False security, right? Buying safe products, so-called safe products, that have loss potential or hidden duration or hidden credit risk. And these are very common mistakes that are totally avoidable, that none of us watching here, or definitely none of us that enroll in the Portfolio Safety Challenge, would ever make. And so these are the types of things that you will definitely be prepared for, and you'll be better off for it. Build, grow, and protect. That's what it's all about. Building an investment portfolio, of course, growing that portfolio, but then protecting. This is the element that gets missed so often, and I don't want you to do that. So that's it. Thanks for watching today's episode. We got new programs coming up this upcoming week. Metals in Motion. We've also got new episodes with USCF Investments, talking all about commodities, which have been in the spotlight, so you won't want to miss that. And hit me up in the comment section below. Let me know how you're doing. And then again, I've got links to the webinar if you missed that, and also enrollment links for the Portfolio Challenge. There is a early bird discount for those of you that enroll on or before July 27th. So when you hit that link, you'll see discounted pricing that will, again, expire on Monday, July 27th. So take advantage of that. We go back to full pricing after July 27th. And hopefully I'll see you there at the Portfolio Safety Challenge. Thank you all for watching. I'm Ron DeLegge with ETF Guide. We'll see you on the next show.